Thank you, Mr. Chairman. Today we've asked our regulators to address the implementation of Titles I and Title II of the Dodd-Frank Act. Title I of Dodd-Frank brought us the Financial Stability Oversight Council, heightened prudential standards, increased leverage, and risk-based capital requirements, while Title II established a new system for resolution of systemically important non-bank financial companies. The U.S. banking system and capital markets must remain the preferred destination for investors throughout the world. It's important that the implementation of capital standards and orderly liquidation are done properly without overburdening our financial system and without placing the United States markets at a competitive disadvantage. In the past couple of weeks, the federal banking regulators have been very busy, issuing a number of rules and guidance regarding capital standards. Very recently, the Federal Reserve, the OCC, and the FDIC issued final rules strengthening the regulatory capital framework for banking organizations, including Basel III. And as the Chairman indicated earlier this year, he and I sent a letter regarding potential effects of Basel III proposals on community banks and insurance entities. So I also appreciate the distinctions made by the regulators in the final rules for these banks and insurers. With regard to the overall capital standards and whether Dodd-Frank ended too big to fail, I look forward to hearing from the regulators on these issues today. I appreciate the hard work that has gone into these capital standards and into producing and reviewing living wills, but many, including myself, believe that Dodd-Frank did not yet end too big to fail. Going forward, we must learn more about the additional steps that regulators plan to undertake to determine leverage and debt-to-equity ratios for big banks, as well as how to treat short-term wholesale funding. It also remains to be seen whether and how orderly liquidations are able to address dissolution of systemically important non-bank financial companies while avoiding financial shocks to the market. As we approach Dodd-Frank's third anniversary, there's a considerable amount of work to be done, such as working through the complexity of the Volcker Rule and issuing the outstanding risk retention rules. Encouragingly, there does appear to be a building bipartisan consensus that some elements of Dodd-Frank may need to be fixed. At the last Humphrey Hawkins hearing, Chairman Bernanke identified the end-user exemption, the swap push-out, and community bank matters for relief in which specific Dodd-Frank provisions could be reconsidered. At our recent hearing on community banks, it became clear that both sides of the aisle agreed that there is a need to provide relief to community banks, especially in rural areas. The regulatory framework that emerged out of Dodd-Frank has made it increasingly difficult for community banks as they are disproportionately affected by the increased regulation because they're less able to absorb the additional costs. In the brevity of time, so that we can get to the panel quickly, I also wish to reiterate the points that I've made at other hearings this year about the potential for cumulative regulatory burdens and the drain to our financial system by the necessity of well-prepared economic analysis and how these rules will affect our economy as a whole and may affect our global competitiveness. It's my hope that today's hearing will also allow us to address the critical and needed Dodd-Frank reforms as a bipartisan consensus grows that we can fix at least some of these issues. Thank you, Mr. Chairman.